All right, rates rising, stocks falling, and can you blame this on Jerome Powell, the Federal Reserve chairman, who yesterday said, you know, we're a long way from being neutral. In other words, we have a lot more hikes to go. That was how it's been interpreted since. Business and financial historian John Steele Gordon on that. John, what do you think?
Well, I think the current rate increase is a sign of our economic strength, not a sign of an approaching bear market, at least not yet.
Yeah, I hope you're right on that. I mean, good news is deemed bad news sometimes. But again, to your point, it depends on the day. But I think what some interpret, and I'd be curious to get your view, is that the Fed chairman was signaling, even though we've been raising rates at a steady pace, there's nothing in the works to indicate we're going to slow down on that. If anything, we could speed up. Was that a correct read?
I think he wants to get back to normal rates, which we haven't really had in this country for over 10 years now.
What are normal rates?
You know, on the 10-year Treasury, like 4%.
And so for Fed funds now in the 2.5% neck of the woods, that's closer to 5, right, normally?
Yeah.
So that would have to double for where we are. That's going to be sticker shock for a lot of folks.
Well, as long as it has to be done slowly. I hope the Fed doesn't do it next week.
Okay, let me write that down. Not a good idea to do now. You know, you and I can remember when rates were much, much higher. Perspective is everything, as I keep repeating here. But the same issues that were running up, ignoring the problem yesterday, are running down today. Is there an equilibrium here? I mean, we're in the middle, and it will be soon, of third quarter earnings season. We're expecting a really strong growth, maybe upwards of 24, 25%, if not more. That's a tough thing to sustain, isn't it?
Well, it certainly can't go on forever, but I think we've got a ways to go yet. And I think, you know, tomorrow's report on the jobs report, and then the third quarter GDP, and then, of course, the earnings reports. And I think they might actually be in the sense that, you know, the market or the economy is getting too good, and therefore the Fed would raise faster, and therefore that would be, you know, a counterweight to the market going up again.
When the Fed chairman talks about neutral, it talks about the environment mixed with inflation and trying to keep ahead of that, right? So you're not behind the proverbial curve. How does that go? How does that thinking go?
Well, I think you have to, you know, the Fed wants a very low rate of inflation,
right?
Because what they sure don't want is any rate at all of deflation. But on the other hand, when inflation gets out of control, as it did in the 1970s, remember interest rates, the prime rate in 1980 was 21%.
Wow. People forget. When I tell people that, too, or that when my wife and I got our first mortgage around 13.5%, 14%, and we thought we were financial geniuses, kids can't believe it today. But it is what you're used to. Is there such a thing as a point where people will say, wait a minute, we know this reflects a good economy, but I've also just seen I've been priced out of that house I wanted to buy. Explain that tug of war.
Well, it's, you know, this is, you know, the market is a Ouija board. We have people pushing it up and people pushing it down, and it can change overnight. It can change in seconds. On, you know, September 4th, 1929, the market had reached a new high the day before, and
yes,
suddenly at 2:30, it just fell out of bed and went from there right down to the crash a month later.
I remember early summer of '87 when the world was our proverbial financial oyster, and a couple of months later. All right, John Steele Gordon, so good getting reminded of history and calm perspective. You provide that, my friend, and much appreciated.
Thank you.